So you've recently decided to purchase some shares in your favorite company on the stock market. You've done your business research, you've bought the shares at a favorable price, and now you're looking forward to collecting some nice returns on that investment. But what you might not have considered is the taxation implications associated with buying, holding, and selling shares. How's it going, everyone? My name is Dan, but you can call me Malone, and today we are going to be discussing the tax implications associated with owning stocks. Nobody likes the thought of having a portion of their well-earned capital gain on their investment taken away from them. Likewise, nobody likes to talk about a portion of that dividend income that they received as a result of owning the share taken away from them either. However, taxes are an unfortunate reality of being an investor, and as a result, it is important that you at least have a basic understanding of how taxes arise when it comes to investments. The simple thought of taxes alone can be scary, and it might be enough to deter someone from getting involved in the stock market in the first place. However, at the end of this video, you should have a good idea of how taxes on stocks arise, and you will hopefully see that it isn't as overwhelming as it may seem. I'll be looking at taxes on stocks in the context of what I like to call the ownership life cycle of a stock, which can be broken up into three distinct stages: the buying stage, the holding stage, and the selling stage. And I will look to discuss the taxes arising at each stage respectively. So before we get started, if I could ask you to please drop a like on the video and consider subscribing to the channel, it really does help me out a lot. So without further ado, let's get started. The first tax I want to discuss is most commonly associated with the selling stage of the ownership life cycle of a stock. It is, in my opinion, the most obvious tax and seems to be the tax that most people have a general understanding of. This tax is known as capital gains tax, or CGT for short. Capital gains tax arises on appreciations or increases in value in your shares over a period of time. The key to understanding capital gains tax is knowing that the tax arises on what is known as realized gains. Realized gains are effectively the gains that come about when you actually sell the stock. Unrealized gains or paper gains are not subject to capital gains tax. So therefore, in theory, if you own a share that has increased significantly in value over a period of time, so long as you continue to own that share personally and don't sell the share, capital gains tax won't arise. Capital gains tax only arises when you actually go and sell the share and realize the gain associated with your investment. This is best explained using a very simple example. Let's say today you decide to buy a share in a company for €1,000. Let's assume that you do nothing else, you don't buy any more, you don't sell any, and we come back in 1 year's time. After 1 year, we can see that this share is now worth €2,000. So in effect, you have now a gain of €1,000. But so long as you continue to hold that share, that gain of €1,000, being the €2,000 value today minus the €1,000 that you paid for it, will continue to be an unrealized gain or a paper gain, and therefore will not be subject to capital gains tax. If, however, we decide that yes, we want to sell that share for €2,000 today, we will in effect realize a gain of €1,000, and capital gains tax will be levied on that gain. So at this point, you might be asking yourself, well, what happens if you have a loss? Let's say we take the same example as before. We buy a share in a company for €1,000 and we come back in 1 year and see that that share is now worth €500. So in this situation, we actually have what is known as a capital loss of €500. Generally speaking, and depending on what taxation jurisdiction you're living in, capital losses can be used to offset capital gains arising on other investments, therefore reducing the amount of capital gains tax that you will ultimately end up paying. However, the same principles which apply to gains also apply to losses. So long as we continue to hold that investment and don't sell the investment, that capital loss will be an unrealized or paper loss and will not be available for us to use against any realized gains that we may have. If, however, we decide to sell the investment and realize the loss of €500, then that loss will be available for offset against any other realized gains that we have on any of our other investments. To use a more relatable or in real life example, we can simply consider a company like Tesla. The investors who purchased Tesla stock anytime before 2020 would have seen a very large appreciation in the value of their investment over the course of this year. Therefore, they would have had a lot of unrealized or paper gains in their respective trading accounts. However, until those shares in Tesla are actually sold, those gains will remain paper gains and no capital gains tax will be levied on the massive appreciation in value of the Tesla stock. However, if the investor decided to capitalize on the large appreciation in value of Tesla stock over the course of this year by selling it to someone else, then of course it can be assumed that they will have a rather large capital gains tax liability, because again, they are turning an unrealized gain into a realized gain by selling the stock. And that's a very important point to consider when you are the owner of a share which is appreciated in value significantly over a period of time. You might be tempted once you actually go and sell the shares to spend all the proceeds on a brand new watch, new clothes, food and drinks, whatever it may be. However, you need to make sure that you actually have the cash left over to be able to pay your capital gains tax bill. You'll see tons of stories online where people end up realizing these massive gains on investments, spending all the proceeds, and then don't have sufficient cash left over to actually manage their tax bill. So don't let that happen to you. The main point to take away when it comes to capital gains tax is that the tax only applies when the actual investment has been sold. Here in Dublin, Ireland, where I currently live, the rate of capital gains tax is 33%. But this will typically differ depending on what taxation jurisdiction you live in. But the overall taxation principles applicable to capital gains tax should be fairly consistent from jurisdiction to jurisdiction, and it's more so important that you just understand the circumstances in which capital gains tax arises. The next tax that I want to discuss is most commonly associated with the holding stage of the ownership life cycle of a stock. This is a tax that we as employees or self-employed individuals are all too familiar with paying. We're typically assessed to this tax on a weekly or monthly basis depending on what taxation jurisdiction you live in and also depending on what your job is. The tax which I'm referring to is of course income tax. Income tax in the context of investments, stocks, portfolios typically has to do with dividend income. That is, you will typically be assessed to income tax on the dividends that you receive from companies. If you don't know what a dividend is effectively a payment or reward that you receive from a company as a result of holding a share or shares in that company. Unfortunately, however, from a taxation perspective, this dividend income is treated as income, and as a result, you will be liable to income tax on the dividend income that you receive from these companies. The rate at which you pay income tax on the dividend income that you receive from companies will of course vary from jurisdiction to jurisdiction, but generally speaking, and speaking from my own personal experience here in Ireland, you pay income tax on dividend income at your highest rate of income tax. This is most commonly known as your marginal rate of income tax. As I mentioned previously, no one likes to pay over a portion of the dividend income that they receive from these companies, because why would you? You're taking on the risk, you're putting the money in, but at the end of the day, you need to give a certain portion of that income over to your relevant taxation authorities. And as I mentioned at the start of this video, that is just an unfortunate reality of being an investor in the stock market. So having a general understanding of how these taxes on stocks arise is very important for the purposes of keeping yourself out of trouble. And what I mean by keeping yourself out of trouble with respect to income tax on the dividend income that you receive generally refers to the fines and penalties that the relevant revenue authorities in your jurisdiction will levy on late payments or non-payments of the income tax that is owed by you. These fines and penalties can vary greatly depending on how large the tax liability is which you owe, but generally speaking, it's better to just pay the tax, get it off your mind so that you can sleep well at night and know that you don't owe any extra tax that you should be paying. The last point I want to make with respect to income tax on dividend income is that on your own personal trading account, you might notice that a small sum of money is deducted from the dividend that you ultimately receive from a company. There's a good chance that that amount is what is known as dividend withholding tax. Dividend withholding tax is a taxation obligation which is levied on the paying company who are paying the dividend to you. The company is required to withhold a certain amount of the dividend that they pay you and pay it over to the relevant taxation authorities as part of their own personal corporation tax liability. This is not the income tax that you owe on your dividend, and I have seen online some people mistaking dividend withholding tax for the actual income tax that they owe to their own revenue authorities. However, depending on what jurisdiction you live in and the actual taxation law of that jurisdiction, you will be able to offset that amount of withholding tax against your own personal income tax liability on the same dividend income. That may sound complex, and there definitely is some complicated tax law from jurisdiction to jurisdiction with respect to dividend withholding tax and how it interacts with your own personal income tax liability. However, for the purposes of this video, I would recommend just understanding what dividend withholding tax is and how it arises. And if you do require any further assistance with respect to dividend withholding tax and how it interacts with your own personal tax liability, I would recommend just contacting a personal tax advisor in your own jurisdiction who should be able to advise you on the taxation implications of both taxes for you. The last tax that I want to discuss today is most commonly associated with the buying stage of the ownership life cycle of a stock. The existence, presence, or relevance of this tax will depend on the taxation jurisdiction in which you live. However, this tax is currently relevant to anyone living in Ireland, and as a result, I did feel the need to include it on this list. The tax to which I'm referring to is known as stamp duty. Stamp duty is effectively a tax which is levied on documents or instruments. Essentially, what this means is that where there is a transaction which involves a document, stamp duty could likely apply. For the purposes of buying shares, stamp duty applies when you're buying shares in companies listed on the main securities market of the Irish Stock Exchange. Generally speaking, stamp duty is charged at a rate of 1% here in Ireland. As I've mentioned, the existence of stamp duty will vary from jurisdiction to jurisdiction, but it is important if you are an investor here in Ireland that if you are buying shares in Irish companies listed on the main securities market of the Irish Stock Exchange, it is very likely that stamp duty will be applicable at a rate of 1%. So for the purposes of this video, it really is just important to be aware that when you are buying shares, there actually can be taxes which apply, and that tax is likely going to be stamp duty. So there you have it. Those are, in my opinion, the three most likely taxes you are going to come across with respect to your own personal investments. As I mentioned at the start of the video, the taxation implications associated with investments can be enough to put someone off investing in the first place. But I wholeheartedly believe that once you have a general understanding of the basic concepts of the taxes which apply and where they apply, then the whole decision to invest becomes a lot more straightforward. We as investors all have personal responsibilities when it comes to accounting for our own taxation liabilities associated with our investments, and therefore understanding these taxation obligations is the first step to carrying out a successful investment journey. Of course, in this video, I have only touched on the actual tax heads associated with each stage of the ownership life cycle of a stock. I haven't gone into any specific detail regarding each individual tax head, as I don't think it would make sense to do so in this video, because the tax laws applicable to each tax head will vary from jurisdiction to jurisdiction and where in the world you live. Again, if you're to take anything at all from this video, it's where, what, and when the taxes associated with the ownership life cycle of a stock arise, and understanding your own personal obligations with respect to those taxes. One point I'd like to reiterate here at the end of the video is that this is not an extensive list of the taxes that you may come across on your own personal investments. If you are ever in any doubt with respect to your own personal tax liabilities, you should always contact a personal tax advisor. The information that I've provided you in this video is for entertainment purposes only and shouldn't be used as a grounds for course of action. Again, if you are unsure, please do contact a personal tax advisor. As I mentioned earlier in the video, getting taxes wrong can have implications with respect to penalties and fines, and you really don't want that. So it is better just to get that peace of mind now so that you know you are treating the tax liabilities correctly. So I really do hope you enjoyed this video and you learned something. If you did enjoy the video, please let me know in the comments below, leave a like in the video and subscribe to the channel. And I'll see you in the next one. Cheers.